Axon Enterprise, the company that started with a stun gun and built a public safety technology empire. If you have seen a body camera on a police officer, there's a good chance it says Axon on the side.
Founder Rick Smith started this company in 1993, not long after a close friend was shot and killed. He wanted to create a less lethal alternative to firearms, and the taser was born.
The taser worked. Law enforcement adopted it broadly. But Smith had a bigger vision. He wanted Axon to become the operating system for public safety.
That pivot happened in stages. First came the body-worn camera, then Axon Evidence, a cloud platform where agencies store, manage, and share digital evidence like video footage.
Today, the software and sensors segment is over 40% of revenue, growing faster than hardware. Software gross margins exceed 70%.
The business model has become deeply recurring. Agencies sign multi-year contracts covering cameras, cloud storage, and software. Once they are inside the Axon ecosystem, they rarely leave.
Taser devices still make up about a third of revenue. Each new product generation, the Taser 10 for example, drives an upgrade cycle across the agency base.
The Fusus acquisition added real-time crime center capabilities. Agencies can now monitor live camera feeds, drones, and sensors from a single interface.
Then there is Draft One, an AI tool that writes police incident reports automatically from body camera audio. Officers log hours on paperwork every day. This reclaims that time.
Motorola Solutions is the closest peer in public safety communications, but Axon dominates the body camera and cloud evidence space in a way Motorola does not.
Over 17,000 law enforcement agencies use Axon products globally. That installed base is both a moat and a distribution channel for every new product Axon launches.
The company is also expanding beyond law enforcement into corrections facilities, federal agencies, and international markets. The total addressable market is much larger than domestic police.
Rick Smith has been at the helm for over 3 decades. His story is personal. The mission is not purely financial. That founder conviction has shaped the culture and the long-term roadmap.
Smith holds significant equity and has consistently reinvested in R&D. Research spending is over 24% of revenue, high for an industrial company, more typical of software.
The risks are real. Axon operates in a politically sensitive space. Any high-profile misuse of its technology generates backlash. The stock has historically traded at a premium to earnings.
There is also government budget dependency. A meaningful share of revenue comes from municipal police budgets, which can tighten during economic downturns or political shifts.
But the structural tailwind is strong. Agencies face pressure to increase accountability and modernize. Digital evidence management is becoming a requirement, not an option.
Axon is one of the few companies that successfully converted a hardware sale into a recurring software subscription at scale. That transition is the core value driver.
The Q1 2026 results are in, and the Axon earnings episode is coming up. We will break down the quarter, revenue growth, software ARR expansion, and any guidance updates from management.
For the full earnings deep dive, the numbers, the narrative, and what it means for the outlook, stay tuned to Charged Alpha.
Axon Enterprise reported Q1 2026 revenue of $807 million, up 34% year over year, and its 9th consecutive quarter of 30+% growth. Future contracted bookings hit $14.3 billion, up 44%. AI product revenue grew over 700%. Guidance was raised. The stock moved up about 1% after hours. This is Charged Alpha. I'm Hudson.
And I'm Lana. Axon Enterprise makes the technology stack for public safety. Taser conducted energy weapons, body-worn cameras, digital evidence management, and AI-powered cloud software for law enforcement and correctional agencies. Revenue comes from 2 segments: connected devices, hardware including tasers, cameras, and drones, and software and services, the cloud platform that drives recurring revenue and retention. Market cap is approximately $25.5 billion.
CEO Rick Smith founded Axon in 1993, building Taser into the law enforcement standard before pivoting the company to a cloud software model. Smith's strategic thesis is that every dollar of hardware sold becomes a recurring software subscription, with the Axon cloud platform monetizing body camera footage, evidence management, and AI dispatch over multi-year agency contracts. The Q1 results reflect both the maturity of that recurring model and the early ramp of AI and drone revenue.
Axon's Q1 2026 revenue of $807.3 million grew 34% year over year, beating the $778 million estimate by $29 million. This marks the ninth consecutive quarter of 30+% revenue growth, a consistency benchmark that distinguishes Axon from most enterprise software companies. Net income was $169 million, with a net margin of 21%.
Non-GAAP EPS of $1.61 beat the estimate by 1 cent, a thin beat that generated less excitement than the revenue line. Adjusted EBITDA was $201.6 million, with a 25% margin in line with full-year guidance. Gross margin was 59.1%, down 150 basis points year over year, as the hardware mix shifted toward lower-margin categories.
Software and services revenue grew 35% to $355 million. Annual recurring revenue reached $1.493 billion, up 35%, with net revenue retention of 125%, meaning existing agencies spent 25% more than last year. That retention rate reflects steady upsell from body cameras into AI dispatch and evidence management.
Within connected devices, platform solutions, drones and dead drone counter-drone systems grew 95% year over year to $111 million. Dead drone alone grew approximately 300%, driven by defense and government contracts. Taser revenue grew 19% to $233 million. Personal sensors, primarily body cameras, grew 23% to $109 million.
The standout metric was future contracted bookings, $14.3 billion, up 44% year over year. This backlog represents signed multi-year contracts not yet recognized as revenue, the best leading indicator of Axon's forward trajectory. A 44% increase at this scale confirms strong agency demand and Axon's ability to win large enterprise contracts.
AI product revenue grew over 700% from a small base, driven by early adoption of Draft 1 AI report writing and AI dispatch tools. Axon raised full-year 2026 revenue growth guidance to 30 to 32%, up from the prior 27 to 30% range. Quarterly free cash flow was $112 million, with full-year guidance reiterated at approximately $450 million.
Analyst reaction was broadly positive on the revenue beat, raised guidance, and bookings upside. North Coast Research upgraded to buy from neutral post-earnings. Baird and Piper Sandler maintained bullish ratings. Consensus across roughly 15 analysts remains firmly positive, with average price targets of $700 to $800, significant upside from the current stock near $385.
The bookings debate is central to Axon's investment thesis. Bulls argue the $14.3 billion backlog represents a revenue runway that makes growth highly visible. If converted at historical rates, current estimates are conservative. Bears argue bookings face government appropriations risk, and that large backlog figures can mask near-term revenue volatility if agencies delay or renegotiate contracts.
The margin debate centers on 2 consecutive quarters of gross margin compression. Software margin is structurally higher, so the model improves as software mix increases, but platform solutions is currently hardware-weighted. Bulls model margins recovering to 63 to 65% by 2027 as AI subscription revenue scales. Bears see continued pressure if drone and hardware revenue outgrows software in the near term.
The AI revenue narrative is early stage but closely tracked. 700% plus growth sounds extraordinary, but dollar magnitude from a small base is modest. The key question is whether Draft 1 and AI dispatch become agency standard, as body cameras did. If AI tools bundle into existing multi-year contracts as add-ons, the NRR uplift compounds. Bulls model this as the next leg of Axon's upsell cycle.
The muted plus 1% after-hours move reflects valuation reality. At 70 times earnings and 9 times revenue, Axon already prices in execution. The market expected the beat. A larger move would have required meaningful EPS upside or bookings closer to $15 to $16 billion. The 1 cent EPS beat and inline margins produced a measured response from investors who bought the earnings run-up.
The bull case is international expansion and AI monetization. International revenue at 20% of total, 160 million in Q1, is significantly underpenetrated in the global public safety market. Each country win is a beachhead for software upsell. Bull's model international growing to 30+% of revenue within 3 years as European and Asia-Pacific agencies modernize their public safety infrastructure.
The software mix shift is the long-term margin catalyst. Software and services compounds faster than hardware because it is recurring and tied to multi-year contracts. As AI tools like Draft One become standard agency requirements, per-officer revenue grows without hardware refresh cycles. The NRR of 125% confirms existing customers are expanding, not churning.
Dedrone counter-drone revenue growing 300% signals a new addressable market. Critical infrastructure protection, airports, power grids, stadiums, creates drone detection demand beyond law enforcement. If Axon pivots Dedrone into a standalone enterprise security product, the addressable market expands meaningfully. The 95% platform solutions growth suggests this expansion is already underway.
The bear case is valuation and margin compression. At 70 times earnings and 9 times revenue, Axon has no margin for error. The 1-cent EPS beat is a yellow flag. Software model leverage is not yet showing in margins. If gross margin compresses further toward 57% as hardware outgrows software, the premium multiple becomes hard to justify.
Government budget risk is the structural bear argument. Municipal and federal agencies fund through appropriations that shift with political cycles. The bookings backlog provides visibility, but signed contracts can be renegotiated if budgets are cut. A budget standoff could pause contract payments and slow revenue recognition in ways the backlog does not capture.
Stock-based compensation is the profitability concern analysts track most closely. Axon guided for 590 to 620 million in annual SBC, roughly 2% of market cap annually, meaningfully diluting GAAP earnings. The gap between non-GAAP EPS of $1.61 and GAAP EPS of $2.05 reflects these adjustments. The SBC overhang is a persistent drag for cash return investors.
Competition is growing from established players and AI startups. Motorola Solutions competes directly in video security and dispatch. AI startups target the report writing market. Draft One serves. Axon's installed base and multi-year contracts provide switching cost protection, but the AI software layer is less differentiated than hardware, creating potential pricing pressure.
Motorola Solutions is Axon's closest direct competitor, selling radio communications, video security, and dispatch software to the same law enforcement customer base. Its video security and access control segment competes directly with Axon's body camera and evidence management platform. Motorola's diversified revenue base and lower multiple make it the defensive public safety tech alternative.
Tyler Technologies serves government clients with software for courts, public safety records, and local administration. Tyler's court and justice platform overlaps with Axon's evidence management tools. Tyler trades at a lower multiple, reflecting slower growth, but its deep government integration shows how recurring SaaS compounds inside long-term government-customer relationships.
Palantir is the AI for government peer most often cited alongside Axon. Both target similar government buyers with AI tools. The key difference? Axon's hardware lock-in through TASER and body cameras creates a captive software upsell channel that Palantir lacks. Axon's NRR of 125% reflects this hardware-anchored recurring model.
On valuation, Axon at 70 times earnings and 9 times revenue commands a meaningful premium over Motorola and Tyler, reflecting growth expectations and AI optionality. The premium is justified if AI tools scale to 20+% of revenue. It compresses if growth decelerates to 20 to 25%. The 14.3 billion bookings backlog is the primary justification for the premium.
Axon's options market ahead of Q1 reflected high expectations, elevated implied volatility with call skew suggesting anticipated upside. Pre-earnings positioning was bullish, consistent with 12-month stock momentum. The muted plus 1% after-hours reaction confirms that anticipated upside was already priced into options premiums before the report.
Post-earnings options activity shifted toward taking profits on pre-earnings calls. Traders positioned for an EPS blowout were disappointed by the 1-cent beat. The market now prices modest Q2 upside, with calls weighted toward the 390 to 420 strike range. A guidance raise or bookings upside in Q2 could catalyze a breakout above 400.
Insider activity at Axon is dominated by founder Rick Smith's significant equity stake, providing long-term alignment with shareholder value. Smith historically exercises options and donates shares to philanthropic causes rather than open market sales, limiting the signal from his transactions. No significant open market purchases or sales were disclosed in the last 90-day window.
The combined signal from options and insider data is constructive. The muted post-earnings move shows the bar is high. A revenue beat does not reprice the stock when it is priced for perfection. For long-term investors, bookings growth of 44% and ARR growth of 35% are the durability signals that matter. Smith's ownership alignment is a long-term positive.
Axon delivered Q1 2026 revenue of $807 million, up 34%, its ninth consecutive 30+% quarter. Bookings hit $14.3 billion, up 44%. Guidance was raised. The stock was largely flat after hours.
Bottom line, Axon is the public safety tech platform with compounding bookings and AI momentum. The bull case is software mix expansion and international growth. The bear case is margin compression and a valuation that prices perfection. The bookings number is the reason bulls stay long.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street